Hi, I'm Nicole, one half of the Wealth Twins, and today I'm talking all about SVB Bank and the collapse of it. We've been getting a lot of calls from friends and family who want to know what exactly went on with this bank and how it's going to affect their money. So if that's something you're interested in, click that like button so we can get started. Now, at a high level, everything that went on with this SVB Bank collapse can be explained using three things: how banks work, the tech and venture capitalist slowdown, and also bad risk management. So let me explain. Now, what is SVB? SVB stands for Silicon Valley Bank. This is a regional bank that focuses on a particular type of client. They were really focusing on tech startups and venture capitalists and also the executives of those types of firms. Now, as you know, the last few years, the tech industry and the venture capitalists, they were cash rich. They were getting money in, and a lot of startups were being built. So those guys had a ton of money, and they needed that money to be parked somewhere. Silicon Valley Bank thought, hey, let's beat our competitors and offer a higher interest to entice these type of customers to bank with us. Now, this is how banks work. Banks take the money that you give them, give you a small interest rate on your money. The way they're able to give you a small interest rate on your money is that they take the money you give them and they invest it in either loans or investments that pay a higher interest. They take the difference between what they're saying they're going to pay you versus what they're getting on their investments, and that's the bank's profit. Silicon Valley Bank offered a higher interest rates for anyone that deposited money in their bank. Now, in order to get a higher interest rate, they had to make investments that paid a higher amount so that they can collect the profit in between. As you know now, there is a huge tech industry slowdown, also venture capitalist slowdown. These guys are not getting as much cash as they used to, and the tech stocks are going down. There is a domino effect that happens. These guys who are no longer getting the funding that made them cash rich now have to use the cash that they have on hand to pay for operations and also to pay payroll. They have employees that they have to pay, and a lot of companies that they invested in are not making money as of yet. They're not profitable. So they have to use the money they have on hand to actually pay for expenses. That money is sitting in the bank. They have to take the money out the bank in order to pay their expenses. Now, normally this wouldn't be a problem. However, this goes back to what's going on. Now, here's when it comes to risk management. SVB, in order to offer those higher interest rates to their customers, actually invested a large amount of their money into long-term bonds. Now, we see it all the time in the news. The Fed is raising interest rates. When the Fed raises interest rates, anyone holding long-term bonds, the price of those bonds goes down. It's an inverse relationship when it comes to bonds. Every time interest rates goes up, the price of bonds goes down. Now, if you don't have to sell your bonds, it's not a problem. However, Silicon Valley Bank had to start selling their bonds because so many of their clients were starting to take out money to fund their own expenses. Now, in order to give these customers money, they had to start selling these long-term bonds. When they started selling these long-term bonds, they started selling them at a loss. That caused an issue on their books. They had more liabilities than they had assets. Okay, so basically that means they had more bills than they had money that they could use to pay these bills. When SVB realized this, they had a press conference where they announced that they were looking for over $2 billion in funding by issuing new shares. That's how they were going to get money into their company. At the same time, they also announced that they're going to slash their profit forecast for the next quarter. Now, anyone that was looking at that press conference, especially the customers who were savvy investors themselves, these are venture capitalists, these are tech startup guys and executives, they realized what the bank was actually saying was they didn't have enough money to pay their bills. They were in a liquidity crunch. A liquidity crunch means they didn't have enough money on hand to satisfy the demand that they were having for people coming into the bank asking for their money. This set off a bank run. Within 48 hours of that press conference, their customers took out $42 billion of money from Silicon Valley Bank. A bank cannot handle that many people coming into the bank asking for their money. Now you may be wondering, why would all these customers start asking for their money back so quickly in such a short period of time? Well, that's because the FDIC only says that it will protect and insure up to $250,000 worth of depositors' money. However, based on December 2022 numbers, it was known that over 89% of Silicon Valley Bank's depositors had more than $250,000 in the bank. That means a lot of their money was not insured by the FDIC. Because these customers became worried due to that press conference, they wanted to get as much money out as possible as quickly as possible because their businesses were going to be threatened if something happened to Silicon Valley Bank. Why do I say that the whole issue with Silicon Valley Bank is bad risk management? They were looking out more for their shareholders and their creditors than they were the actual depositors of the bank. On top of that, they were also being greedy by saying that they can get a higher interest rate for their customers. If Silicon Valley Bank was more conservative with their estimates and understood that a trifecta storm like this could happen, where it was in an environment when the tech industry was slowing down, the venture capitalist industry was slowing down, and rates were rising, if they did some type of risk management in a scenario where all those things happened to take place, they would have realized they had too much money parked in long-term bonds. Because Silicon Valley Bank decided to play this game of getting high interest and playing that profit game, they ended up having a problem on both ends. They weren't able to pay as many depositors as they had, and at the same time, they weren't able to sell the securities that they had invested in for a profit. This was the perfect storm for a bank run and also a collapse of a bank. Now, why should you care about what happened at Silicon Valley Bank? You're not a tech startup, you're not a venture capitalist. Why should you care? Well, the reason why you should care is because once people start making a run on banks, and a lot of irrational fear starts taking place in the marketplace. Maybe customers start thinking, well, if it happened to a bank that's been around for 40 years, how do I know my bank is safe? So those irrational fears led to not only people taking out some money from other banks like Signature Bank, but also leading to the stock prices of regional banks and some big banks to go down, like First National Bank. Their stock went down, and also even JP Morgan's stock went down, just based on people's fears that maybe we were reliving another Lehman Brothers crisis moment. Now, if you don't remember, back in 2008, Lehman Brothers went down, and that helped set off the great financial crisis because it made everyone realize that a lot of banks had the same type of securities as Lehman Brothers did. So whatever happened to Lehman Brothers can happen to another bank. And that's why the government had to step in and bail out certain banks. Now, the government has said that it will not bail out another bank. So how do you relay those fears? Well, the Federal Reserve, the Treasury Department, and also the FDIC has stepped in to make sure that this contagion is actually being contained. So what they're doing is, over the weekend, they have decided that they're going to pay every depositor their money, all their money back, regardless if it was more than $250,000. That is a relief to everyone that has deposited their money into Silicon Valley Bank. Because if they weren't able to get all their money out, you're going to see more of a fallout with these tech companies then having to, close down because they can't pay their employees. And you don't want that type of domino effect to continue. On top of that, the Federal Reserve has decided to put out a new program where banks that might have similar situation where they're holding long-term securities and their investments may be underwater, or those that may just be affected because of Silicon Valley Bank situation, but have nothing to do with the matter. If they're just affected because of irrational fear, the Federal Reserve has stepped in to say they will provide loans to these types of institutions so that they can continue with operations and no fear of having to go to the market and sell for a loss. This should help contain that contagion. We will see. We don't know. Hopefully, people will say that it's okay and they don't lose confidence in the banking sector. That's the main thing that the government and the Federal Reserve do not want. They do not want us losing confidence in the financial banking sector. Now, for those that are customers of banks and have more than $250,000 in one bank, you should take this as a lesson to not hold more than $250,000 in a bank. I'm not just talking individuals, I'm also talking to small business owners. If you have more than $250,000 in the bank, remember it will not be insured. So your best bet is to actually spread your money out to different banks. On top of that, it's better to look into like money market funds who specialize in using short-term securities to make sure that they have liquidity and also that they can pay back their customers. Look into short-term instruments like T-bills on your own as well. You have to make sure as a business owner that you're always able to make payroll and that another bank's or another institution's situation does not affect your situation. So hopefully this answered all your questions. And if you found any value in this video, please show this twin some love and also consider subscribing to the channel because we would love to have you as part of our community.